this administration, the Supreme Court just struck down Trump's tariffs. The ruling passed 6-3, so not even close, actually. And there are a couple of things we're taking away from this. Number one, what the Supreme Court is saying is President Trump has to go through Congress in order to put tariffs or other tax increases in place. And as you know, we've called tariffs tax increases. I don't like tax increases. Most people don't like tax increases. So you'll notice that the equity markets are up today and the bond market is not selling off that much. So this was getting into the market. I think there was there were a lot of people suggesting that the Supreme Court would do just this. Now, of course, President Trump has come out and said, okay, fine, 10% tariff across the board then. And again, that will probably have to go back to the Supreme Court. I think that Trump doesn't want to lose negotiating leverage with the rest of the world. But there's something else going on. If you've noticed what he's been doing in recent weeks in response to the affordability crisis, is he has been taking tariffs off of categories like beef and coffee and furniture and necessities. So that's very interesting. He also wants to see inflation, headline inflation, going down. And so I think that this 10% tariff talk is just that. He doesn't want to lose leverage in negotiating with other countries. And if you think about it, he has been getting some very significant deals having to do with foreign direct investment in the United States to restore our manufacturing base. And of course, a lot of that is around technology and the new tax law, which accelerates depreciation dramatically. So we do think the return on invested capital in the United States is going to go up because of deregulation and tax cuts. And we're going to have a lot of foreign direct investment. Now, one of the characterizations of trade deficits, which President Trump believes are disastrous, is that the rest of the world is really taking business from the United States because of unfair trade practices. And he has been using this negotiating leverage around tariffs to create a more even playing field. I don't know how much leverage he's lost here, but if you look at the last year of the trade deficit, it has not gotten better because of tariffs. In fact, if you measure it in terms of goods, it's gotten worse. As many of you know, our position on trade deficits is different from that of President Trump, because the other side of a trade deficit is a capital surplus. And a capital surplus, we think, that is going to go up because of foreign direct investment, because of our new tax rules. Now, algorithms in the market, and when there's fast breaking news, it is the algorithms and high frequency traders that take advantage of the breaking news. I think the first response was, to take the market down from what was a very nice up day to something lower, not lower on the day, but just taking some of the gains away. But now the markets, the equity market's coming back. The bond market sold off, but it too is coming back. And the yield curve, interestingly, has flattened a bit as long rates have not reacted the way that people expected them to, meaning go up a lot. So I think the markets are treating this with a bit of a yawn. I will say that the more innovation-oriented growth portfolios, especially aggressive growth portfolios, are having a bit of a setback. One of the reasons is defense tech. I think that a lot of people feel that the defense sector will be hurt because we're going to have less revenue coming in from tariffs to spend on defense. And I just think that is, I don't think that's going to happen. I think defense spending is going to continue apace, if not accelerate. So that's when you know algorithms are taking over, when something like defense tech responds to this piece of news. One other thing I'll just note, since the numbers were out today, real GDP growth was surprisingly low. At one point, I think the Atlanta Fed estimated that real GDP growth in the fourth quarter would be 5.3%. It came out today at 1.4%. And what happened? Well, the trade numbers were revised down, in other words, into more of a deficit. So you can see even recently, the tariffs haven't helped our trade deficit. There also was the government shutdown. And so we do think there were a lot of distortions in that number. And if anything, with tariffs coming down, if they are tax increases, and tax increases hurt growth, we believe, the opposite should be true now that they have been struck down. This should actually accelerate growth. A tax cut encourages more growth. And it also will take some upward pressure away from our inflation statistics. So the trueflation number, as we've been saying for quite some time, is lower than 1% now, having peaked at 12% at the peak of the COVID crisis. These are 10,000 consumer prices monitored 24/7 continuously. So those pressures had already started coming off the inflation rate before this tariff announcement. So they could get us, the tariffs coming down actually could get us closer to zero or negative during the next 3 to 6 months. We shall see. So we're not worried about what's happened in a way, as I've described. It is a positive. I think we've been pretty consistent saying tariffs are a tax. Taxes are negative for growth. We take them off, and I think we'll probably see more growth this year than we otherwise would have. So with that, I'll wish you all a happy weekend and look forward to next time.